In today's show, you'll hear investor perspectives on the COVID-19 impact on startup fundraising. This is Investor Perspectives. I'm the host of Investor Connect, Hall T. Martin, where we connect startups and investors for funding. It's the time of COVID-19. We're in lockdown looking to reopen the economy in the U.S. The virus has changed the way the world looks with empty streets, shuttered stores, and death counts rising. There are signs of flattening the curve, so we now look to the other side when the economy will reopen. I hope you enjoy this episode. Today we have with us Christian Kameir, managing partner of Sustany Capital, who has been on Investor Connect before. So Christian, what is the short-term impact of COVID-19 on startup funding?
Well, I think you have to look at this a little more nuanced as just calling startup funding in general, because the way I look at these is startup funding essentially falls into three buckets, right? And what most people don't realize, most startup funding is actually done from their own revenue, right? A lot of people start a business on the side and then eventually it generates enough revenue to sustain itself. And then from there, ideally, they raise funds later. That's actually what we like to see the most. And a lot of that revenue, needless to say, now has disappeared depending on what type of clients they were serving. But a lot of that has gone by the wayside. And then secondly, and that is also before any type of angel or VC funding, you're looking usually at friends and family rounds. And needless to say, a lot of friends and families that you could have turned to before the situation will now lack any type of cash to contribute. So then lastly, if you look at VC funding, and then take the examples that we saw in 2008, where actually angel and seed funding increased after 2008. Significantly by about 34%. But then on the contrary, Series A declined significantly, I think by about 20%. But what we saw thus far for the first quarter of VC funding in the US dropped by a quarter, so about 25%, and in China dropped by half. But it's also fairly important to understand what is being funded right now, even if you look at this from the perspective of, well, 75% of funding is still around. A lot of this money actually came from what we call mega rounds. So those are companies that raised over $100 million. So that was 50 companies that raised the bulk of those. So those 50 companies all raised more than $100 million. And then the obvious one being the true impact will only show itself now in the second quarter. But on our end, as far as like anecdotal and personal experience, we already see lower, more what I would call more realistic valuations. Because unfortunately, there has been a period of time where everything was kind of overhyped and bullish, and we saw a lot of Series A requests for valuations that were of 10, 20, sometimes $30 million. And usually, we like to see these rounds being closer to being between 5 and 10 on the high side. So this is kind of my personal view as far as I can tell, our 20 years experience, what we expect the short-term impact to be.
Great. So what do you think the long-term impact of COVID-19 will be on startup funding?
Well, you probably heard this other way, but good companies often emerge out of recessions, right? Over half of the companies in the Fortune 500 are founded during a recession year. And a lot of like 50 tech unicorns that we had, they were also founded in the period of 2007 to 2009. So the WhatsApp, Slack, Square, all of those started in 2008. Uber started in 2009. So I think we actually will see more interesting companies coming out of that because it will focus companies on actually developing great tech. And that's a feedback that we got a lot from companies that we've been monitoring for some time. Because the way we invest is we don't, and good investors don't do that, we don't invest into dots, we invest in lines, meaning we'll touch base with a project we find interesting in reference to our specific investment thesis, establish where they are, and then check back on a regular basis to see what the progress is, unless obviously there's an imminent funding event to be had. But generally speaking, we like to see companies over a period of time. So as far as the long-term impact, I think it's going to be, at least for our purposes, quote unquote, positive, right? It's going to lend itself to more focus, which you want in an investment scenario.
Next up is Peter Adams, managing partner of the Rockies Venture Fund and Pandemic Impact Fund. So Peter, tell us, what is the short-term impact of COVID-19 on startup funding?
Well, I'll just share what I've seen short-term, and keeping in mind that, we have a lot of impact of things that started, before this pandemic started. But so far, it's been fairly minimal. We've been still holding a pace at doing 2 or 3 investments a month. And most of those, diligence was done, of course, before pandemic started. We've done extensive surveys and talked with all of the companies in our portfolio. And it's interesting, there's some who are actually doing better thanks to the pandemic. Others are performing about as expected. And then, of course, others are seeing some negative effects. But none, happily, are very serious. And one thing I keep hearing that we're going to see short-term in angel and venture capital investing is a drop in valuations. And so far, we've seen a little bit of correction, but I expect we will see that increase as the economy continues to suffer a bit. Plus, a lot of these deals we've negotiated, a few months ago before this all started. I think, a lot of the valuations we've been seeing, and I'm sure you've seen this whole over the last year or 2, 3 years, has really gotten kind of frothy as the investment market's gotten pretty hot. So what I would expect is maybe over the next year or so, we see a regression to the mean of maybe where we saw valuations 3 or 4 years ago. So this is a time when uncertainty is affecting startups, especially those who are doing their first round of investments. What we're seeing both in our strategy and then in others is funds and angels are reserving more and more capital for follow-on so that we can ensure resiliency of the investments we've got. And I think that's going to be something to watch. So for startups, I give the advice I've given for years is remember to look at your angel investments as a partnership and, communicate with your angels, keep them updated, and don't just, think the investment stops or the relationship stops after the check.
Well, great. Well, in 2008, we saw the valuations come down by about 20%. And this will be probably in the ballpark. And at that time, I noticed that it was the Bay Area valuations, which were the frothiest, that were coming down the most. How frothy is the Rockies area as far as valuation? How far up does it go? I'm sure it's not as high as the Bay Area, but what do you think it is?
Yeah. So, it's interesting when you do the reports on PitchBook, and we actually had Silicon Valley Bank come in and did some research for us on this as well. And sort of the Rocky Mountain, Intermountain West, and even Midwest tends to be trailing in valuations by about 20, 30%. So over what we see on the coasts. So that's advantageous for investors in the space. But what's cool, and I did not realize until Silicon Valley did this research, is as these companies move toward exit, they move to parity with coastal companies because, of course, they're being acquired by the same companies who are acquiring coastal companies. And so the valuations at acquisition are going to be about the same. So that actually represents a great differential and benefit for, Rocky Mountain companies, or Rocky Mountain investors, rather.
I see. Okay. Well, that's good to know. So what do you think the long-term impact of COVID-19 is going to be on startup funding?
Yeah, great question, because it's actually quite different than just the short-term effects we've seen so far. I think we'll see some good things and, unfortunately, some not so good things. Certainly, we've seen a lot of investors have become more gun-shy. Capital will be in short supply. And then there are going to be trickle-down effects of, massive unemployment. As of this morning, 33.5 million people unemployed. And that's going to slow down demand, especially as people move into new markets. And that's not just going to be on B2C type companies, but also B2B will be impacted severely. And I think, another challenge to this pandemic is there's nowhere to hide. I mean, this is truly a global issue. And when we see the economic slowdowns that result from this, this is going to be, really global. It's going to impact supply chains as well as demand. So that will be tough. But on the other hand, I think there's some positive things that will come out of this. I think the companies who do survive are going to be more resilient. They'll learn how to do more with less. They'll learn how to be more creative and reaching out to new markets and being effective. They're going to I think a lot of the practices that businesses do are not going to see a full regression to the mean. People always say, oh, once we get back to, the way it was last February or early March. Well, we may never go back there. And so companies that do pull out of this may end up with a lot more efficient practices. Things like they probably have a lot of extra people they didn't really need, maybe reducing some of this high cost office space now that we figured out how to work better remotely. Same thing with travel. And, just this whole working at a distance, I think will impact a lot of things. And then the other thing is, I think even though we have lost a lot of this face-to-face experience, which, as you know, in angel investing, this is a contact sport. This is, it's very personal. We're investing in people. I mean, it's great to be able to have those face-to-face meetings. But while that has gone away, I think we have created a lot of new ways of engaging with people far outside of our basic community. So I think we'll have more relationships with people in broader communities, and that's going to be great for both investors and for startups.
Now we have Jake Rosenfeld of Correlation Ventures. So Jake, what is the short-term impact of COVID-19 on startup funding?
So on startup funding specifically, I'm super interested in seeing the contraction of pre-money valuations play out and whether or not that will play out. So I think for the past several years, we've seen unproven products, unproven business models go out and raise capital early on in the life of a company at relatively high prices. And it'll be super interesting to see how those prices do come down, potentially not immediately, but perhaps over time over the next year or so. I think if you were to look at data from obviously the dot-com bubble bursting, as well as the 08-09 crisis, right? The months and handful of years following that, you did see valuations come down significantly. I think the major distinction between those time periods, and particularly 08-09 and today, is the amount of dry powder out in the venture ecosystem gunning for the next wave of technology-enabled businesses that are emerging. So it'll be interesting to see how it shakes out. I'm still pretty bullish on it being a decent time to raise early stage capital. And the interesting thought exercise, in my opinion, to go through relates to the question, is it better today to be almost a very young company, whether it's pre-launch, pre-revenue, or had just launched, versus a company that has had the benefit of a year or two of traction and data and revenue, and potentially that revenue now flattening a bit. So it should be interesting to see. At Bonsai, we were pre-product launch up until about 4 weeks ago. So I like to think that, for us, it's an opportunity to really kind of keep putting our head down on product development, and inevitably, when the time is right, start getting that initial kind of bit of traction and product market fit to prove our hypotheses and our product value out. So interesting to see how those prices shake out. I think net, it'll be a positive thing if valuations do contract a slight amount.
Well, that's great. As far as valuations go, I find across the U.S. there's different variations, regional variations on the valuation and how high that went up. Of course, the West Coast is very high and the Midwest is not so high, and the East Coast is somewhere in between. And so it seems like the higher it gets valued during the good times, the more it has to come down when we start over times, I guess. Where do you think the East Coast is on that quadrant there? Is it all the way up where the Bay Area is, or is it all the way down there where the Midwest is?
It's a really good question. I think about this a lot. So I worked for a firm called Correlation Ventures based on the West Coast, and I ran the New York City office. So I got to see almost like this juxtaposition of cultures. And without citing any data, my conclusion has been, at least thus far, that New York or East Coast investors are a bit more pragmatic when it comes to making early investments and pricing companies. Whereas you have a little bit more, innovation and risk taking that falls into the laps of West Coast investors and entrepreneurs. So I think that's why you see this distinction between the two reflected in pre-money valuations. I think New York prices historically are a little bit more reasonable. But still, over the past few years, I mean, before I left DC to start Bonsai, you'd see, a repeat founder go out with a PowerPoint or a deck and raise a $3 million seed round at a $18 million post money without a line of code written and without an idea for how revenue will come in. And I think those days are probably going to be behind us.
It's going to be tough to do that anymore, for sure. Well, that's great. So what is the long-term impact of COVID-19 on startup funding?
The long-term impact, I think, is just going to, at least in terms of where my brain goes to, relate significantly to the sectors we choose to invest in, both as founders and operators and as investors. I think that a lot of we could talk all day about the healthcare space, the education space, et cetera. I think it's going to be really interesting to see where the big innovations come in both of those two sectors and where the big financings occur in both of those two sectors. I'm interested to see what happens and what shakes out with a lot of these direct-to-consumer brands, particularly a lot of these direct-to-consumer brands that have had physical footprints established over the last few years, and whether or not there will continue to be investment specifically dedicated to building out a physical retail component of some of these digitally native businesses. I don't necessarily think that long-term that's going to be as hot and heavy as it has been over the last year or two. But nonetheless, I think, if long-term we can focus on building interesting things for distributed work, interesting tools for distributed workforces, interesting tools for online education, and call it e-learning, the world will be legitimately a better place. And then, long-term, it'll be fascinating to see how we all respond to investing in and building really the next layer of those two sectors that involve human interaction. You talk about universities falling potentially. And the question is, you could get a lot of online education and be quite credentialized and prepared, perhaps even in the future, to go get a wonderful entry-level job after not attending university, but learning a whole bunch of great stuff online. The question is, at what point are you able to grasp onto that socialization and that human connection that a traditional university campus has granted students in the past? So I'm interested to see where investing happens across those sectors in particular. I think everything's cyclical, right? So as far as pre-money and post-money valuations are concerned, it seems as though dip for a bit and come back. And I do think that, long-term we'll probably see the financing of more sustainable business models with more predictable streams of revenue versus what we were seeing over the last few years in terms of, again, going back to that founder with a deck and some past exits under his or her belt, going out and raising at a crazy valuation from the get-go.
Right. Crunchbase did a report before COVID-19, and most investors thought the market was overvalued by about 30%. Do you think we're going to get back down to that near 30% drop, or do you think it's going to come out a little bit above that?
Personally, I think 20% is kind of where my gut tells me. And again, this is not based on any data. It's truly what my gut tells me. Yeah, I'd say 20%, maybe perhaps 30. And you know what? It could depend on the location, as you alluded to earlier. East Coast, West Coast, Midwest, et cetera. And it certainly might tie to the founder. There's a chance that, again, that serial entrepreneur who has a few exits under his or her belt will still be able to go raise money at the same prices he or she did a few years, over the last 2-3 years. So we'll see. I guess the jury's still out.
Next is Phil Nadel, founder and managing partner of Forefront Venture Partners. What is the short-term impact of COVID-19 on startup funding?
Some investors are pausing on investments in certain industries until they see how things shake out post-COVID. I think also that investors are spending more time and capital on their portfolio companies, which makes it more difficult for startups to raise. I think, generally speaking, the bar is just set a little bit higher today. Venture capital investors are being a little more conservative, and I think we're seeing a little bit of an adjustment to expectations and perhaps valuations as well.
What do you think is going to happen with valuations here in the short term? How much down will they come?
I think it depends a lot on the sector and how companies have been able to weather the storm. So it's difficult to put one number to it. I think it's very sector dependent. I think certain sectors will take a big hit in terms of valuations and others won't be impacted at all. And still others could even see an increase in valuations, those sectors that are specifically geared for or profiting from the pandemic or are better now situated for what could be the post-pandemic world.
Very good. So what is the long-term impact of COVID-19 on startup funding?
Well, I think that we're going to see, a sector shift. I think that we're going to see investors focusing more intently on different sectors and less so on others. I mean, for example, I think that investors who might ordinarily be interested in the tourism or travel space are more likely to take a pause on investing there, hold off for a while. So I think that also companies, because of the uncertainty, companies will want to raise more money than they might ordinarily, maybe combining a few rounds, and would be okay with taking a lower valuation to have the security of more money now. I think, going back to the question, I think that investors will focus more on sort of mission-critical businesses, and that startups will need to show more proof points, more traction. I think investors will do more due diligence and take a little longer to do that. And as I said, I think there'll be a shift to certain industries, certain sectors.
You think we'll see manufacturing come back to the U.S.? And do you think people will get back into hardware products and applications in a bigger way?
I think that there will be a general move to onshoring manufacturing as well as certain other industries. I think that there's been a lot of concern about being reliant on other countries for goods that we need desperately and can't live without, and to be reliant on another country for that seems to many now to be too great a risk. And so onshoring, I think, will be an increasing trend. But I do think that what goes hand in hand with that is an increase in automation, in robotics, in AI, in the supply chains, which will create some long-term resilience and reduce the reliance on humans working face-to-face. So I think that that's a trend we'll see more in the factories as this onshoring occurs, and even in sectors where just business is already done in the U.S.
It seems like quite a turnaround in the last 6 months ago. Robotics, it was coming to take your job, be very afraid. And now it's a mission critical tool because the workers are in quarantine. And so it seems like that's really changed that industry quite a bit. I hear robotics investing is up dramatically at this point.
Yes. And it makes sense. I mean, just today I read that Amazon is planning to introduce a robotic in Whole Foods stores to do cleaning and disinfecting in the stores by robots. So, yeah, look, it does make sense. Some of that is based on the current, environment and wanting to be socially distant and not reliant on as much face-to-face contact. But I think a lot of that will stick post-pandemic. I think that businesses are going to want to reduce the face-to-face contact and reliance on humans and, be able to automate processes without the need for human interaction. I think that will, a lot of businesses are seeing the value of that today. And it becomes, I think the plea that you've been hearing or the cry that you've heard in the past about robots are coming to take our jobs will not resonate as much because now people understand that there is an inherent risk in that.
And next up is Steve Shapiro, managing partner of eHealth Ventures. Steve. What is the short-term impact of COVID-19 on startup funding?
Hi, Hal. I want to start, I think it's very important with everything going on today to give a personal thanks to so many people that have put their health at risk to really help their communities, and for all of the frontline heroes, just to give a shout out and thank them. And, we're seeing how exposed our economy has been, how the healthcare system has been, and every day. And he talks about disasters stronger and better, from 9/11 to massive shootings to hurricanes. When it's all said and done, we learn from it and we make things better. And I see this as an opportunity for entrepreneurs that really have the hustle, the ingenuity, and the ability to kind of create and build on what they're doing and create new opportunities. And that kind of fits into just how we look at funding and what we're doing in the short term. Particularly, I'm part of eHealth Ventures, and we invest in early stage digital health companies. We have 11 portfolio companies, and we run an incubator. And before this stay-at-home order, our companies would come to our facility every day, to our incubator, when we work. And now with the stay-at-home orders, us, like the rest of the world, things have changed. So the first thing we did is to have a daily call-in first thing in the morning with all the CEOs of our portfolio companies and let them share some stories and what are their goals for the day? What have they learned? How are they approaching it? So we take advantage of having a number of companies to kind of learn and grow. And it also connects people, rather than sit at home, gives that connection. Secondly, as all companies are doing, we're finding ways to cut costs with our companies. We're also identifying the low-hanging fruit. Because we're in digital health, and I'll get into that, it does open a lot of opportunities for us. And so we really want to look at each of our companies and how they look at it and how their particular product, their application, their software can be enhanced and to fit more specifically, with COVID-19. We also want to take this opportunity because fundraising is slowing down. Everything that I hear for private funding, it's dropped by VCs almost 70%. But in the case of biotechnology and digital health and healthcare in general, it's not fallen so bad. So we're actually happen to be in a good space. But the checks aren't being written nearly as fast. And we want to increase the runway for each of our companies. And we also wanted to use this time to connect with key opinion leaders, where it may have been very difficult, where someone goes to the office for 9 to 5, they're working in a busy healthcare environment. Many of them are at home right now. So it may be a little bit easier to connect with key opinion leaders and start working and develop a relationship with them. Because we need that as we go to raise money to get that endorsements. And lastly, communications is really a key. And with all the stakeholders, so we have a venture fund and people are nervous. What's going on? They watch the stock market fall. So we have open communication with our limited partners and our stakeholders. And we've actually had some webinars with them telling exactly what's going on, what we're doing, talk about how some of our companies are able to benefit through the coronavirus. So we see that important. And the board of directors, we're on the board of all of our companies, but they have a board of directors. So they have met and they look at the business plans and we have to rethink them and see how it can be effective. We don't want to get away from our core technology, but we have to lengthen the runway. So how are we cutting costs? And in probably every case, our employees have taken a pay cut. And, we want to see how far our existing cash will last us because we know it's going to take a little longer to raise the money. And I'll give some examples on how we've done it, if that's okay. So one of our companies is called DermaDetect, and they actually have a telehealth application for a dermatologist to use to assess some type of a skin lesion or a problem someone has with their skin. So what we've done is we've reached out to our international partners to offer it for free to different healthcare organizations for the remainder of the year that they can use this as a way to solve people with dermatology problems. We're using this to really get our word out there and start using it. So once it's over and we'll start charging them, we've kind of built up a base. We have another company that deals in pain management. And so they have a tool that help you manage pain. And so they're actually offering remote training for people interested for pain management training remotely to work with it, even if they're not using their application yet, to help with that. So we're looking at each company and how can they spend their time most effectively and to build up their image. Another company that's not part of our incubator, but I'm working with, is called True Triage. And they're in the emergency and urgent care area of triage. So if somebody has a problem, how do they have to have an ambulance taken to the emergency room? Is it something that can be solved through telehealth? And so we're really trying to build that up and focus because it's a big area right now. Our emergency rooms are being overflowed, and let's not get people in the emergency room that don't have to go to the emergency room. So those are some of the short-term things that we're working on.
Great. So what do you think is going to be the long-term impact of COVID-19 on startup funding?
Well, that's the magic question. I mean, there's a lot of unknown. We think there'll be a new normal now, that things are not going to go back to the way that they were. Fortunately, most of our investments are pre-revenue. So we're using this time to really get the product ready to go to market, to commercialize. One of the biggest errors that's really hurt us is the clinical trials, and almost all cases have been suspended with our companies. But that's something that in the long term will certainly be ready and be more ready for the clinical trials and have our plans worked out so we're really ready to ground running once we're able to get back in with the hospitals and doctors that we're working with. Fortunately, we're in the digital health space, and everything I read and see and our feedback is digital health. Some people knew what it was. Some people didn't know what it was prior to the COVID-19. And we're at a different place today, and it's going at lightning speed now. Everybody. In fact, 10 minutes ago, I got a call from my physician and just letting them know that they're available for telemedicine calls. Literally happened 10 minutes ago. He never did them before this. So, it's a new world. And also the regulatory bodies and the CMS, they are now allowing a lot more telehealth to occur than it was before. A year and a half ago, a doctor was not even reimbursed for a telehealth call. So it never took off in this country. And now they're reimbursing for it, and they've increased the amount of the reimbursements. And it used to be it had to be within your state. So if somebody needs a telehealth call, they have to call a doctor within their state. If it goes outside of their states, it didn't qualify for reimbursement. So they've eased up on that. So it's great opportunities. And there's a lot of companies that are in that space that are just growing phenomenal. So when we look at companies to add to our portfolio, and we're actually very aggressive on looking for companies now, because we are fully funded, our venture fund, and like of other funds that are fully funded, they are, spending money. They're being more cautious. Valuations are being hit pretty hard, which is good for the VC, but not for the entrepreneur, obviously. So we're looking, to really grow our base right now and to build for long term. And, we've certainly reassessed the type of companies we're looking at, and we're being a little more particular than we were before.
So you mentioned that clinical trials were suspended. Is that because coronavirus patients are distracting everybody away from that work, or is there some other reason?
No, because all of the clinical work that's being done is all related to COVID.
Oh, okay. So at the clinical level, they diverted
So
everything to COVID-19 research. Thank you for joining us today. As always, be sure to leave a review, subscribe to this podcast, and share it with others. Let's go start up something today. Halti Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinions of Investor Connect. This podcast is for informational purposes only and should not be relied upon for the basis of investment decisions.